$10,000 of software development costs in Q2 2026 and $209,000 for the first 6 months of 2026, compared to $0 and $23,000 respectively in the comparable periods of last year. The costs mostly reflect the investment we made in our social monitoring and insight and analytics enhancements that we rolled out during the second quarter, as well as some additional enhancements Brian will speak more about. Operating loss for Q2 2026 was $307,000 compared to $249,000 during the second quarter of 2025. For the first half of 2026, operating loss was $1 million compared to $926,000 in the first half of 2025. The year-over-year change was primarily driven by a lower gross margin, partially offset by lower operating expenses. On a GAAP basis, net loss from continuing operations was $354,000, or 9 cents per diluted share for Q2 2026, compared to $239,000, or 6 cents per diluted share during the second quarter of 2025. For the first 6 months, net loss from continuing operations was $965,000, or 25 cents per diluted share, compared to $1 million, or 26 cents per diluted share in the first half of 2025. On a non-GAAP basis, EBITDA was $0.5 million, or 8% of revenue for the second quarter of 2026, compared to $0.5 million, or 9% of revenue during the second quarter of 2025. Adjusted EBITDA was $0.6 million, or 11% of revenue for Q2 2026, compared to $0.8 million, or 15% of revenue in Q2 2025. Non-GAAP net income was $0.3 million, or 8 cents per diluted share during the second quarter of 2026, compared to $0.6 million, or 14 cents per diluted share in the prior year quarter. Adjusted free cash flow was $50,000 for Q2 2026, compared to $250,000 in Q2 2025. For the first half of 2026, EBITDA amounted to $0.5 million, or 4% of revenue, consistent with the first half of 2025. Adjusted EBITDA was $1.2 million, or 11% of revenue, compared to $1.4 million, or 13% of revenue in the prior year period. Non-GAAP net income was $0.7 million, or 18 cents per diluted share, compared to $0.8 million, or 20 cents per diluted share last year. Adjusted free cash flow was $1 million for the first half of 2026, compared to $1.2 million for the first half of 2025. Cash flow from operations was $173,000 in Q2 2026, compared to $135,000 in Q2 2025. We ended the quarter with just under $3 million in the bank, and Brian will talk a little further about our share repurchase activity, which was ongoing during the quarter. The deferred revenue balance, which we expect to recognize over the next 12 months, was $5.1 million as of June 30th, 2026, compared to $5.3 million at December 31st, 2025. As we enter the second half of the year, our financial priorities remain consistent. Maintain operating discipline, invest selectively behind the products and go-to-market initiatives that can drive revenue and subscription growth, and continue to strengthen the economics of the business. The progress in subscription ARR per customer, continued positive adjusted EBITDA, and our focus on cost efficiencies gives us a solid foundation as we work to improve top-line performance. With that, I will turn it back over to Brian.
Thanks, Steve. To expand a few points of what Steve mentioned, let me try to tie to actionable results that you will see in the back half of this year, as well as the things that we have planned on our radar. But first, I want to begin by discussing a little bit about our capital allocation, specifically our share repurchase plan, which has continued nicely this quarter. We repurchased 40,000 shares for a little over $300,000 in the quarter, pushing our total repurchase results since December 25 to 90,000 shares, or $700,000 as of today. This leaves us roughly $300,000 in the plan to be used here this quarter. The buyback has resulted in us retiring over 2% of our common shares outstanding to date. Once the plan is completed, the board of directors will review the company's performance, share price, and liquidity, and if all continues to align, we will institute another repurchase plan. It is my belief that we will continue to be active in buybacks as we continue to run the business with the cost discipline you have seen from us here this year, which has resulted in a 23% reduction in G&A this quarter. Additionally, as Steve mentioned, we have also undertaken steps to implement cost savings initiatives that we expect to reduce cost of revenue by approximately $150,000 in the back half of this year, or 125 to 150 basis point improvement. Cost-cutting is not our singular motive. The cost of revenue savings is being deployed around the business, specifically in sales and marketing, with our new hires to fuel customer acquisition and top-line revenue growth for the future. Something that we will watch and work hard to deliver both in growth and customer counts, at the same time maintain or reduce our customer acquisition costs. Having the incremental gross margin savings and anticipated customer revenue growth will help us also improve to move our gross margins back into the higher 70% range in the back half of the year. We are expecting these new products that will be released the rest of the year, as well as average initial purchase increasing as the two drivers to this expectation. For the quarter, both our social monitoring add-on and our new Kill the Report, now called Insight and Analytics, performed well. Specifically, the new Insight and Analytics is driving average purchases higher, seeing several hundred customers opt to upgrade to this new actionable Insight dashboard. We have learned a lot in the past few weeks that this report has been available to our customers and intend to continue to push the envelope in leading the industry in report engagement, brand monitoring, and real-time actionable sentiment. Social monitoring also solidified a missing component of our platform and will help us push our offerings to a broader audience in the future, specifically under some of our brands like pressrelease.com, where customers will be able to begin buying social monitoring for 30 days to try before committing to a full annual subscription. We believe this will help our smaller SMB customers understand and derive value from our platform without the bigger commitment up front. Now, what is coming? We have a full product roadmap for the second half of the year. I will try to touch on a few key components, but be sure to be watching for our marketing messaging and press releases to learn more. On the investor relations side of the business, we have two products ready in the queue. The first is an extension of our commitment to excellence and really a part of our ACCESS Verified solution that we rolled out earlier this year at no cost to our clients. This is geared towards our reporting and publicly traded customers, whereby they can submit their earnings release, or really any financial release, into our ACCESS Verified for Financials platform and get back an assurance report. What our platform is looking for is the consistency of financial tables into and with the narrative to be sure that every representation of a financial metric is accurate, crossed, ticked, tied, and consistent throughout the document. We have tested this with hundreds of customers' earnings releases from the past, worked with our investor relations community and audit firms to gather feedback, and are excited to bring this to market this coming week. Second, on the IR product front, we'll begin our upgraded ACCESS Events platform, where we are upgrading our events workflow technology into and with our ecosystem. This new upgrade will allow customers to pre-schedule their entire year's earnings calls, advisory releases for earnings announcements, and move between shared solutions from our PR and IR in a seamless way. Our continued commitment is to have two new upgrades to our customers each quarter. One that improves communication workflow and technology by allowing our customers to tell their stories easier and with more options at no additional cost, and a second whereby we provide a value add-on and a small incremental increase in the press release, actionable, or subscription business. By doing this, we feel we will continue to drive value to our customers beyond what the market is doing, and also put us in a position to have the opportunity to garner higher revenues as the incremental products are utilized. On the public relations side of the business, we have a new content distribution component we think is going to be spectacular, both not only in the future, but truly well beyond and where we're headed as a business. The first initial rollout is going to give customers the ability to expand upon timed distribution of a press release to a broader audience without all the complexity of human capital time to accomplish this. This new feature will give customers the ability to select any social platform, journalist group, and tailor their messages to those audiences within our platform, rather than going to several different tools to post press releases and everything else to accomplish this. In early Q4, customers are going to have the option to add on our new ACCESS Content Studio, or at least the initial version of this fully robust MCP-supported product. The Content Studio will connect to your social accounts, build an FAQ of your business and brand message for that press release, sketch out a white paper and newsletter or blog, and format all of these options to automatically be delivered to your audiences wherever they consume your message and content. We see this opportunity to roll this out to our customers at a 10 to 15% increase in current subscription. The value to the customer is going to be significant. First, they will have one central real-time platform for all their engagement analytics, story generation, audience building, and targeting wrapped into one. This innovation will lead us to a full studio toolbox concept that we have spoken about recently. By the end of the year and into next year, we will be releasing. As I said earlier, we have a full product pipeline that is robust and tied to our revenue growth strategy over the next couple of years. It is not easy to articulate all of these and what we're doing while remaining competitively agile as one of the only publicly traded newswires. Customer numbers were up 24% in Q2 for this year compared to last year, an increase of 6% over the prior quarter as well. Where I'm most encouraged is in the private customer growth that we achieved this quarter. This is largely being driven from our e-commerce initiatives as private company brand platforms. As we continue to learn from these customer needs, we feel very good about moving a fair percentage of these customers into subscribers over the next 12 months. Today, it's about delivering for them, helping build their stories, and educating them on the immense opportunity our platform can bring to a brand when they're seeking to find coverage and exposure. But it's critical to listen to them today, so we're afforded these opportunities in the future. In Q2, ARR increased 15% year over year from $11,039 to $12,718, as Steve and I said previously, pushing subscriber revenue 23% higher for the prior period. We also ended the quarter up in total subscriptions, ending with 1,162, up 4% from 1,119. Retaining these customers is critical to our long-term business. Retention for the quarter was 94%, up 2% from the end of Q1 this year and 3% prior year quarter. Our net revenue retention has also continued to grow since last year and now ended Q2 at 124%. It would be nice to guide improvements here in retention and net revenue retention, but our focus in the back half of the year is going to be on new subscriptions while maintaining this threshold for current customers in the back half. Additionally, we continue to focus and refine our other revenues and learn how we can move these customers into lower tier subscriptions. Like we have said before, these are reoccurring at the time of delivery revenue customers that do commit to a fixed amount of dollars spread over a fixed period. That business today is approximately 40% of our overall revenues, or non-subscription revenue, if you think about it that way. And what we have planned the second half of the year, we will see our recurring revenue business, our ARR business, get closer to the 80% number where we want to be this time next year. So why are all these new products, metrics, or customer growth and increased investment in sales and marketing important? Well, Gartner recently published a report that speaks to the PR industry, calling it to double by the end of 2027. AI being a significant contributor to this. This is exactly what we have been saying to our shareholders late last year and early this year. We independently also have a view that this market is going to return to double-digit growth in 2027 and beyond, and we intend to capture it. Yes, AI is enabling this, but the number of new businesses being formed is also driving this assumption. This is coming from the research that we've done that we'll refer to as the hustle generation. This is tied to tiers right between Gen Z and millennials. These are the new decision makers in the IR/PR landscape, and a growing number of these have both regular career positions and side hustles, resulting in these additional businesses being registered and needing help tell their stories with products that we have brought to market this year, like social monitoring and our insights and analytic reports that have contributed to revenue in the second quarter. Although I'm not fully satisfied with the overall results in the second quarter, I am proud of the advancements that we've made, and we continue to enter a new phase for ACCESS. We have one of the most comprehensive investor relations and public relations platforms in the industry that can be between both public markets and private enterprises globally. We remain confident in our ability to continue to strengthening our competitive position from here. I want to thank our teams, customers, partners, and shareholders for their trust and ongoing support that allow us to bring ACCESS into every company in the world. With that, I'll turn the call over to the operator for questions. Operator?
Thank you. At this time, we'll be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. And the first question today is coming from Luke Horton from Northland Securities. Luke, your line is live.
Hey guys, thanks for taking the questions. I just wanted to touch on pricing. As you think about all of these product enhancements kind of slated for the back half of the year, how are you kind of layering in any pricing increases or add-on pricing, or just how do you think about pricing in general, given the product enhancements slated for this year and going forward?
Yeah. Hey, Luke, it's Brian. Each of the products that we've released already, the Insight and Analytics and Social, give customers the ability and so to try before you commit and have a different pricing tier. So let me try to walk through a couple of them. In the Insight and Analytics, for example, Our customers that pay for a press release as they consume it without a long-term contract or subscription have the option to add it to any press release for an additional fee. So there's an incremental increase. We're seeing the benefits of our average price per release increase as a result of that. We think that's going to continue to get better. There's about 600 plus Insight Analytics reports will run during kind of half of the Q2 period that we released that product. Our social monitoring, for example, initially was rolled out as an upgrade for $200 a month for our subscriber clients. They had the option to opt into that. Starting next month, we're going to move that product to, I think I said earlier, on our pressrelease.com platform to give customers the ability to try before they commit to a longer-term contract. So, like I said, we're hopeful that each of the quarters going forward over the next 6 to 8 quarters, we're going to have 2 products. One that further identifies the moat that we're building for our platform to give our customers more ability to establish their brand voice and their story in their press release without any additional cost. And then a very competitive product advancement that has an economic benefit to us. So this always ties back to our strategic view a couple of years ago when we guided to 15,000 in ARR. We have a product pipeline that will get us there. So the Content Studio will be another incremental $200 to $300 a month. The customers can add this on, and then the toolkit at full release next year will drive even more value. And that's not to say that we may not release a couple of additional things along the way that, again, have a no charge benefit to give our customers some value and keep them sticky.
Okay, great. That's helpful. And then I guess just on the kind of sales efforts here, I guess how much of the focus is growing with your existing client base versus kind of outbound sales efforts, and any of these product enhancements specifically geared towards kind of customer acquisition or more so just kind of giving them a better product and growing with existing customers?
Yeah, the investment in sales and marketing is really kind of a bifurcated model. It's very comprehensive, and Steve mentioned it earlier in his prepared remarks. For the first half of the year, we probably spent 50% more in trade shows and conferences, right? Getting ourselves out there into the field to start to talk to customers on the street, understand their needs, what they're looking for, and build our brand to help drive pipeline for us, an opportunity. On the flip side, from a sales investment, we've hired more headcount in our sales teams to be able to handle the number of inbound leads. And so conversely, for the past year, we've been focused on how do we take a customer from $10,000 to $11,000 to $12,000 in ARR? How do we convert customers from a bundled package of press releases to an ARR subscription model? And we've done that, I think, relatively well. We've done it with good retention. We've done it with good net dollar retention. And because of the investment in sales and marketing, now we're turning our focus more to outbound new customer acquisition to push and really deliver on the top line numbers that we want. Will help fuel our growth for the future. So it's been a little bit of both, but right now we're really wanting to maintain our current account base. We still feel like there'll be small percentages of our customers will see value from a bundled product to a subscription, but the growth really over the next 6 to 12 months is going to come from new customers coming into the platform.
Okay, great. That's super helpful. Thanks, Brian.
Thank you, Luke.
Thank you. And the next question will be from Jacob Stephan from Lake Street Capital. Jacob, your line is live.
Hey guys, appreciate you taking the questions. Solid quarter here. Maybe just building off of that last sales and marketing effort question. I guess, is there a CAC or, maybe a payback period that you're kind of factoring into your underwriting? And I guess, do you ultimately expect that shows up in subscriber trajectory throughout the back half of the year here?
Yeah, we definitely do look at it, right? And we've been tracking our CAC for the better part of the last year plus as it relates to subscriptions and non-subscription customers. We kind of look at the CAC differently for both of those. The CAC paybacks on press release, incremental pay-as-you-go or e-commerce business, after the first release essentially pay for themselves. It's up to our sales team to continue to manage those accounts and move them into subscriptions or repetitive press releases and bundles as they go. The CAC, as you'd appreciate, is a little more expensive on a subscriber because the length of time it takes to convert somebody. Generally, a 3 to 6 month window is what you're really looking at from pipeline building. So it's the cost to do that is a little higher. However, it has come down over the last quarter or two. We believe it will continue to come down. We're bullish about the industry, like we talked about with what Gartner released here just about a month ago, to look at what this industry is doing and seeing some of the backup data that has provided some assurances that both our strategy, Gartner's independent research, as well as census data, is giving us the confidence that we can continue to grow this business and not increase our CAC significantly. If anything, bring it down over the coming quarters. Something we'll likely get to talking about externally. But like I said in one of my prepared comments earlier, as being the only publicly traded newswire, there is a little bit of competitive advantage we get by not saying too much. And I hope that our shareholders appreciate and understand that. But we want to be cognizant of both giving our shareholders and prospective shareholders all the data they need to make an investment decision, but also maintain ourselves a little competitive advantage against the quadrant.
No, it makes sense. I guess maybe just transitioning over to your ARR, per sub. I guess, when you look at the sequential decrease, only about $100, but anything that's driving that, is that lower on the higher ARPU subscriptions or more EDU customers? I wondered if you could kind of break that out for us.
Yeah, I think it's the private company space. We talked about it being a big incremental push to us. We are trying to find entry points. We said it in the prior quarters. We're trying to find where there could potentially be significant scale in customer subscription numbers at a lower tier price. So we are going into certain verticals, trying to find a lower priced ARR product that can get us into those markets and try to find a way to learn, iterate, and scale fast. So that's a result of what it is. To be fair, our public company customers that are renewing and adding on, those ARR values are growing. So our net dollar numbers are good. We're just finding a little more success at a lower price point. And we've talked about this. So I think we'll continue to see some of that. What will help subside it, obviously, is the new product adds that we've got that will impact ARR. So we shouldn't see a sequential decrease as much as we'll see kind of a consistent number across the board here in Q3, and then in Q4 will grow because of some of the hard dollar ARR add-ons. But not alarming for us. It's expected. We talked about it in the last couple of quarters on our calls, that it's something that we're experimenting with.
Okay, got it. I appreciate all the color. Thanks, Brian.
Great. Thanks, Jacob.
Thank you. And the next question will be from Brock Irwin from Clever Investing. Brock, your line is live.
Hey guys, thank you for taking the question. So just thinking about the industry overall over the last several years, obviously there's been a trend of contraction. So I'm just thinking about, your forecast, not really a forecast, but you're thinking about 2027 and how you think there's a chance that the industry gets back to growth. I would say that 20% growth rate number you mentioned sounds pretty optimistic. I guess the question is, what gives you the confidence and what data points are you seeing, maybe from talking to customers at trade shows, that would help indicate that there is, a chance that the industry grows? And then the other thing I'm thinking about is, you're talking about a lot of startups being formed around AI. And these might be smaller companies who maybe don't want to spend thousands of dollars, on press releases. I guess the previous question was talking about lower price points. So I guess, as we're moving into a lot of AI startups being formed, how are you thinking about addressing that type of customer differently from, some of the public company customers that you have today?
Yeah, I'm going to try to gather all that up, Brock, and answer it. And if I miss something, let's peel it back a little bit and do it. So the contraction in the industry over the past couple of years, again, not just for us, but the entire marketplace, I think has really been driven upon the confusion of what it is I need as a business, whether enterprise or SMB, to try to figure out how best to tell my story. There's been a significant amount of point solution entrance into the market during that time, which typically causes people to slow down in decision-making processes because there's so much. That noise is starting to move itself away, and customers are now saying, okay, let's get back to basics. This is what we're being told out in the field. And because of AI, what do we need to be doing differently? Are our press releases being featured and seen in citations and LLMs and listicles? And if they are, who does it best? And who does it best, we need to go there. That's our North Star. And so we're trying to position ourselves to be that entity. We're not trying to build our business around AI. It is an enablement of disruption for the tools and the services that we provide to our customers. And so the example of that is this Content Studio, right? So you bring up the comment about being optimistic about growth in 20%. Gartner looks at this as an AI disruptor space growth. Our large enterprise customers that come to us are now saying, we love your IR website solutions, your earnings call products, your press releases, and all the other PR tools. But what are you doing to address our AI needs? Large enterprises are building AI teams to kind of help, both from material non-public information risks to expansion of brand down the hall to the CMO and the CCO suite. So there's bigger opportunities that will come to all of us in this industry in the future as we grow. But to your second comment about startups, Brock, we feel that's where the market really is for some of this disruption and potential growth, because if these hustle generation people are out there, they don't have the bandwidth to do all this work. So they're going to be looking for a tool and a technology that can help them, whether it's one press release a month or one a quarter or two a year. They're going to need those other products. And so it's going to be less about how many press releases we sell to some of these clients, more than it is, can we give them a communications platform for them to do the things that they need? Because again, this is their side hustle. This isn't their primary job. When you look at census data, right, what are our data points is another part of what you asked. We've taken our own view of the market over the past couple of years, and we've said this publicly that we think it's going to get back to growth. Gartner reaffirmed that with their estimates and their analyst information. They're going to publish a Magic Quadrant here in October. We'll all take a look and see where we all sit there. But what else is out there? So we went to census data and said, let's every single county in the country, 3,100 plus of them, let's figure out how many incorporations are being formed 2024, 2025, and the first 6 months of this year. And we're seeing a 14% increase in the number of corporations being formed as LLCs, S Corps, C Corps. We understand clearly that a percentage of those are, I have a harebrained idea, let's incorporate, and nothing ever happens. We know that. Some of them are formed for purposes of transactions and tax efficient measures. We know that. But that's been consistent throughout the years. What we're seeing is that growth in that demographic we're talking about. So we're spending a good amount of time understanding that. One of the reasons why we've been out in the space, and Steve mentioned this, investing in marketing and trade shows and conferences, we're going to events that are not public company events. That's where we spent 20 years. The last 8 months, we've been out at events that are small business expo events, that they'll be in the Javits Center in New York, and there'll be 8,000 customers, potential customers there, sponsored by Verizon and all the other big brands, and we're there as the press release and communications partner. So there's big opportunities for us there. That's where we see that quadrant of people moving to and looking. So I don't know if it's growth just from AI, right? I know you said that there are AI startups. We're not focused on those. We're focused on just that generation of gap of people looking for a side hustle, and also those folks with the decision makers. They're coming in, moving guys like me out, right? The old guys and the younger people are coming in, making these decisions, and we want to be on both sides of the fence for them to have a platform that they would select. Hope I covered it there, Buck.
All right. Yeah. Thanks for your answer. I appreciate it.
Thank you. And once again, it will be *1 if there were any other questions at this time. And there were no other questions from the lines at this time. I would now like to hand the call back to Brian Balbirnie for closing remarks.
Thank you, Paul. I appreciate it. As always, I think this has been like 14 straight quarters we've been using you specifically for our event. And like all of our customers, we love that dedicated premium solution for our public company customers. A lot to digest here today, a lot of data points that we've provided that we typically don't provide, such as market opportunities and growth. I'd love an opportunity to digest more with you and talk about this individually. Just shoot me a call, an email. Let's set up some time to do it. We appreciate your passion for what we're building. We appreciate your commitment for what your position is in our security, and we look forward to the rewards in the future. Thank you all for today and your time.
Thank you. This does conclude today's conference. You may disconnect at this time. Thank you.